Just off the highs, guys. Happy Monday, everybody. 3-1 advancing the declining stocks. Another great start to the day. The dollar's moving up. Transports are up. Transports were down 6 days in a row. Finally, a positive day here for the transports. But don't kid yourself. It's still trade related. Look at the Dow movers, for example. I don't normally put them up, but it's all trade names. Caterpillar, Dow, DuPont, Boeing, Intel. What? Intel's 25% of their revenues are from China. Coke and the defensive names like McDonald's, they're all kind of flattish. It's trades. But that's good enough. And don't look at the numbers right now. I pointed this out at the end of last week. We are very close to historic highs again. Right now, 2.5% from an historic high on the Dow Industrials. Under 4% for the S&P. NASDAQ is 6%. Russell 2000 is 8.5% now based on the gains today. So keep an eye on that. Only a couple hundred points away from the Dow on new highs. And it's really a global rally. We had a nice move up in China overnight. Nice move up in the stock 600. So Europe's at a 5-month high. China's at a 9-month high. Japan's at a 3-month high. We're doing well here. It's good to remind everybody what the tailwinds and headwinds are, because I think there's a little confusion about what the headwinds that we're facing are. So the tailwinds obviously is the Fed being patient right now in terms of what's moving markets. And the China trade deal, nominally a positive, although it could go negative here. But global growth is still very much a problem with China and Europe. I know some people suddenly think that if we get a China trade deal, all of a sudden the global growth story will become a tailwind, but that's not necessarily the case. Another issue out there is the strong dollar that's still floating out. Dollar's up again today. So just keep an eye on that. And remember something. This is the reason why we've gone to negative earnings growth. Slower global growth, particularly in China and Europe, is why we've now gone negative in the first quarter on earnings. Second quarter is heading that way. Third quarter is flattish. And everybody back ends growth in the fourth quarter. They do this all the time, and the first quarter is weak. So we're looking at 4% growth on the year. A lot of people have 0% growth, and it's all tied to the slowdown, particularly in Europe and in China. Now, if that can turn around, then we can stop these downward earnings revision. And that's why I say, give me some sense of where the global slowing story is going, and I can tell you where earnings are going. The first, most important thing to get the markets moving towards S&P 3000 is to stop the downward earnings revisions. And you can see this in the earnings cuts. Look at the companies, the sectors that have had the biggest earnings cuts so far this year. Energy earlier because of the decline in oil. That is now reversing. That's good news. Materials and technology. These are the two sectors that are levered most to the global economy. And those are the ones, particularly in the semiconductor group, Jim pointed that out correctly earlier, that's had the biggest downward revisions. If we can stop that downward revision in those two groups, we're going to have a big part in slowing down the earnings declines that we have been seeing overall. As for whether that would help, J.P. Morgan does. This morning, they had a note out to their clients saying if a trade deal materializes, it will remove uncertainty and could be a source of positive revisions, positive earnings revisions, since this catalyst is mostly not in the consensus numbers. So the question is, has the market fully sniffed out the trade deal story or not? But we need that, certainly, to stop the earnings declines here. Right now, we're up 72 points on the Dow.